Financial Regulations. Chapter 2. Revenue Collection and Accounting. Financial Regulations, Chapter 2, deals with revenue collection and accounting. This chapter covers the complete life cycle of government revenue, from generation to collection to recording to lodgement to reporting to control. And for exam success, you must understand one central principle very clearly. Government revenue must be collected in full, properly recorded, promptly lodged, and strictly accounted for, with no room for diversion, delay, or manipulation. Now, before we go into the detailed regulations, take note of the master rules in this chapter. These are the rules that appear again and again and again. First, the gross rule. Record the full amount. No deduction first. Second, all revenue must go to the Central Bank of Nigeria or another approved government account. Third, receipts must be official. No private receipts, no temporary receipts. Fourth, the cash book must be updated daily. Fifth, the accounting officer remains fully responsible even where duties are delegated. Keep those in mind because the whole chapter keeps coming back to them. If you are serious about passing this exam, don't stop here. I've prepared the complete study materials for you. Detailed ebooks for Chapter 1 and Chapter 2, clear audio versions you can listen to anytime, and if you want the best value, get the full bundle, ebook plus audio combined. Everything is already waiting for you. Check the link in the description and the pinned comments now. Now, let us begin. Financial Regulation 201, Definition of Revenue. Revenue refers to all income or economic benefit accruing to government within a financial year that increases net assets. Now, this is very important. Revenue is not just cash received. It also includes money earned, value gained, such as waived liabilities, investment returns, and income from assets. The key components of revenue include legal receipts, such as taxes and levies, property income, interest and dividends, bank earnings, and waived obligations. That last point, waived obligations, is a very tricky exam point. So, the correct exam interpretation is this. Revenue means gross inflow. Revenue does not include government contributions, such as capital injections. Take note of that distinction. Financial Regulation 202, Consolidated Revenue Fund, or CRF. The Consolidated Revenue Fund is the central account of the federal government. All revenues meant for federal government operations end there. The components of the CRF include 1. Government share from the Federation account, 2. Government share from value-added tax, and 3. Independent revenue. That independent revenue includes personal income tax from specific federal categories, operating surplus from government enterprises, revenue from MDAs, and other declared revenues. Now, here is a very important exam distinction. Do not confuse the CRF with the Federation account. The CRF is the federal government account. It is used for federal government spending, and it includes internally generated revenue. The Federation account, on the other hand, is a shared account. It is shared among the federal government, the states, and the local governments. And it includes oil revenue and other major taxes. Do not confuse those two. Financial Regulation 203, Federation Account. The Federation account is a pool account. Its major sources include oil and gas revenue, petroleum tax, companies' income tax, import duties, excise duties, and revenue from solid minerals. The key interpretation is this. Revenue in the Federation account is collected centrally and then distributed among the tiers of government. So, once again, CRF, Central Account of the Federal Government. Federation account, Shared Revenue Pool. That distinction is highly examinable. Financial Regulation 204, Classification of Revenue. This is a very important area, and it is often poorly understood. Revenue is classified into two major categories. The first is exchange transactions. In exchange transactions, Government gives value and receives value. Examples include sale of goods and services, fees for services, and rent on government property. A simple way to remember this is you pay and government gives you something in return. The second category is non-exchange transactions. In non-exchange transactions, government receives money without giving equal value directly. Examples include taxes, fines, grants, and donations. A simple way to remember this is you pay, but government does not give direct equivalent value in return. Now, here is the exam trap. Taxes are non-exchange. Fees are exchange. Do not reverse them. Financial Regulation 205, Payment of Revenue. All revenue due to government must be paid into the appropriate government account, as may be established with the Central Bank of Nigeria from time to time, except where otherwise expressly approved by the Minister of Finance. So the rule is very clear. All revenue must be paid into the CBN or another approved government account. There is a strict prohibition against personal accounts, retention by officers, and diversion. The only exception is where there is express approval by the Minister of Finance. That is the rule. Financial Regulation 206, Revenue Recognition. Revenue must be properly recognized, accurately measured, and correctly reported. And this must be done in line with approved accounting standards. Simple but important. Financial Regulation 207, Remittance Rules. This is a high-yield exam area. Listen carefully. The computation of operating surplus payable by federal government public enterprises must be in line with the template provided by the Fiscal Responsibility Commission in consultation with the Office of the Accountant General of the Federation. Now, the rules. All federal agencies fully funded from the Treasury must remit 100% of their internally generated revenue, or IGR, to the Consolidated Revenue Fund. All partially funded and self-funded federal government agencies or parastatals must remit an approved percentage of their revenue from the preceding month to the CRF, and they must do so not later than the 14th day of the subsequent month. That date is important, not later than the 14th day of the next month. Also, after preparing the financial statements for the previous year, those partially funded and self-funded agencies must remit to the CRF the balance of approved operating surplus, if any. So, remember the key points. Fully funded agencies, 100% IGR to CRF. Partially funded and self-funded agencies, approved percentage. Deadline, 14th day of the next month. Year end, remit the operating surplus balance, and the operating surplus computation follows the FRC template. Those are common exam points. Financial Regulation 208, Stamp Duties. Under the original rule, stamp duty must be deducted from the contract's value, excluding VAT, and remitted to FIRS before payment is made to the beneficiary. That is the regulation position. However, in your updated exam preparation context, stamp duties have been abolished effective 31st of December 2025. So, the best exam strategy is this. In a theory-based financial regulations exam, answer based on the regulation. In a current affairs or updated exam setting, mention the abolition. A good answer format is: stamp duties were required to be deducted before payment. However, they have been abolished as at 31st December 2025. That way, you preserve both the regulation and the update. Financial Regulation 209, Estimate and Budget. Corporations and revenue collection agencies must prepare and submit to the Minister in charge of Budget the following. First, a schedule of estimates of revenue and expenditure for the next 3 financial years. Second, an annual budget derived from those 3 financial years in line with the National Development Plan. And third, a projected operating surplus prepared in line with the template provided by the Fiscal Responsibility Commission in consultation with the Office of the Accountant General of the Federation. The deadline is also important. These must be submitted not later than the end of the second quarter of every year. So, remember, 3-year estimates, annual budget, operating surplus projection, end of second quarter. If you are serious about passing this exam, Don't stop here. I've prepared the complete study materials for you. Detailed ebooks for Chapter 1 and Chapter 2, clear audio versions you can listen to anytime, and if you want the best value, get the full bundle, ebook plus audio combined. Everything is already waiting for you. Check the link in the description and the pinned comments now. Financial Regulation 2010 on payment deductions. For efficient collection of withholding tax, value-added tax, stamp duties, and pay as you earn, those taxes must be computed, deducted at source, and remitted to the relevant tax authority at the same time that the net payment is remitted to the beneficiary. The taxes involved here are VAT, WHT, PAYE, and stamp duties. So the rule is simple. Deduct at source. Remit immediately. Delay amounts to misconduct. Financial Regulation 211, Chart of Accounts and Accounting Manual. Accounting officers must ensure that the chart of accounts and the accounting manual for their MDAs and other arms of government comply with the National Chart of Accounts. The accounting manual must also be subject to the approval of the Accountant General. That is the control requirement. Financial Regulations 212 to 217, Receipts. This is one of the most important areas in the chapter. The rule is that every payment must be supported by an official treasury receipt in proper treasury format and stamped. Temporary receipts are prohibited. Privately printed receipts are prohibited. Let that be clear. Now, Treasury Book 6, called the General Receipt, is used by sub-accounting officers except where specially approved receipt books, license books, or digital receipting devices are used. The original receipt must be completed in ball pen, and double-sided carbon paper must be used to make the duplicate and triplicate copies. The original is handed to the payer. The duplicate, supported with completed Treasury Form 15 or 15A, is used as the Cashbook voucher. The triplicate remains in the book. The same rules also apply to special receipt books or license books arranged in the same manner, except where digital receipts are used. Where fixed fee licenses or tickets of the counterfoil type are used, the counterfoil of each license or ticket must be initialed by the issuing officer. Now, Treasury Book 6A, the Revenue Collectors Receipt Book, is used by all revenue collectors, except where specially printed books or approved digital devices are used. Again, the original must be completed in ball pen. Duplicates, and where applicable, triplicates, must be prepared with double-sided carbon paper. Where fees are fixed, the amount must be printed on the receipt or license, and under no circumstance shall the printed face value of a fixed fee license or ticket be altered to a lower or higher amount by a revenue collector or sub-accounting officer. Now, note the exam traps here. The duplicate copy is the Cashbook voucher, and printed fees must not be altered. Very important. Financial Regulations 218 and 219, Cashbook and Collection. This is another critical area. Every revenue collector must keep a cashbook in which all receipts are recorded in strict serial numbering order on the day of receipt. The money must be promptly lodged in the appropriate government account, and the return must be made to the sub-accounting officer or other prescribed officer on a daily basis. The lodgement must be supported by Revenue Collectors Paying-in Form, which is Treasury Form 15A, and the duplicate receipts must be acknowledged by the sub-accounting officer and included in the monthly returns. The revenue collector must insert in the Paying-in Form the revenue classification codes to which the collections are to be credited, and ensure that the chart of accounts classification codes are correct. Where receipts or licenses are of fixed value, and that value is printed on the form, the details need not be given in the paying-in form, and counterfoils need not be attached. The necessary information is then supplied on Treasury Form 15A. Where a document itself constitutes a receipt, such as a passport booklet, or where adhesive postage stamps are used as evidence of receipt, a register showing full particulars must be maintained by the revenue collector, and each entry must be checked and initialed by the responsible supervising officer, who must satisfy himself that all such revenue has been collected and brought to account in the Cashbook. Federal revenue collectors resident in the states must lodge all collections to the appropriate federal government account. And for accountability purposes, revenues received monthly as federal government independent revenue by all MDAs and federal pay offices and lodged into the appropriate government revenue account must be posted in the general ledger and reflected in the monthly trial balance. Also, all receipt entries in the revenue collector's Cashbook must include the dates and numbers of all receipts issued, and the revenue collector must obtain an official receipt for all monies paid in. So, remember the core rules here. Record daily. Maintain serial order. Lodge promptly. Use Treasury Form 15A. Include receipt numbers and dates. Use the correct classification codes. Now, the exam traps. Late lodgement is an offense. Wrong coding is an accounting error. And revenue not posted to the trial balance means incomplete accounting. Financial Regulations 220 and 221. Control and accountability. Every revenue collector must submit his Cashbook and receipt books for examination by the sub-accounting officer. The revenue collector must also submit the revenue Cashbook and other source documents to the sub-accounting officer for examination on a weekly basis. The sub-accounting officer must, on a monthly basis, prepare revenue reports to be submitted to the accounting officer with a copy to the Accountant General. The Office of the Accountant General must carry out regular checks, inspections, and monitoring of revenues of the MDAs and other arms of government. Sub-accounting officers, federal pay officers, and other pay officers are responsible for ensuring that revenue collectors lodge their collections into the appropriate government account and submit their Cashbooks for examination. So, the flow of control is this: revenue collector, daily and weekly submission; sub-accounting officer, review and report; accounting officer, oversight; accountant general, monitoring. And the key principle is this: delegation does not remove responsibility. If you are serious about passing this exam, don't stop here. I've prepared the complete study materials for you. Detailed ebooks for Chapter 1 and Chapter 2, clear audio versions you can listen to anytime, and if you want the best value, get the full bundle, ebook plus audio combined. Everything is already waiting for you. Check the link in the description and the pinned comments now. Internal control is continuous, it is layered, and it is compulsory. Also remember this: supervision does not remove responsibility from higher authority. Financial Regulation 222, Revenue Bank Account. Each MDA and other arm of government must maintain a separate bank account for revenue at the Central Bank of Nigeria or any other designated bank approved by the Accountant General. The balance of the account at the end of the month must be transferred to the Consolidated Revenue Fund account. On no account shall any withdrawal be made from the revenue account other than for the purpose of transfer to the CRF. Any MDA or arm of government that earns revenue in foreign currency must ensure that such revenue is paid to the designated account in the Central Bank of Nigeria or any other approved bank for MDAs and other arms of government outside Nigeria. So the rules are: the account must be with CBN or an approved bank. At the end of the month, transfer to CRF. Withdrawals are strictly prohibited. This means the revenue account is a temporary holding account only. A very important exam trap is this: revenue account is not the same thing as expenditure account. Using the revenue account for spending is a serious violation. Financial Regulation 223, Examination of Cashbook. When a revenue collector produces his Cashbook for examination to a sub-accounting officer, the triplicates or counterfoils of his receipt books must be checked against the receipt entries in the Cashbook. The revenue collector's Cashbook must be balanced daily, and the cash or its equivalent must be produced in support of any collection not paid in previously. Examining officers must stamp, initial, and date in ink the last receipt or counterfoil examined in each receipt book. They must also initial and date the revenue collector's cash book after being satisfied that all monies received have been correctly accounted for. Measures must be taken at each examination to ensure that no receipt book issued to a revenue collector is being concealed for fraudulent purposes. And as far as possible, all books on issue to a revenue collector must be produced for inspection on each occasion. Any book not produced at a particular inspection must be called for at the next inspection. And where fraud is suspected, the examining officer must immediately report to the accounting officer with a copy to the accountant general. Examining officers may also impose additional checks as may be required by the circumstances. So the checks here include comparing receipts with the cash book, ensuring all money is accounted for, balancing the cash book daily, and ensuring that the cash book is supported by actual cash. Fraud detection measures include checking all receipt books, ensuring none is hidden, and treating a missing or concealed receipt book as a fraud indicator. That is very important. Alteration of receipts. Whenever an incorrect entry is made on a receipt or license, the receipt or license must be cancelled and a new one completed. The cancelled receipt or license, including the original, must be retained in the receipt or license book. So the rule is simple. Incorrect receipt, cancel it. Issue a new one. Retain the cancelled copy. No correction. No overwriting. That is the rule. Departmental control. It is the duty of the accounting officer responsible for revenue collection to ensure that all collections are correctly and promptly brought to account. None of the checks and controls required to be carried out by the sub-accounting officer relieves the accounting officer of the ultimate responsibility of verifying that all collections are brought to account. In addition to any other checks considered necessary, revenue collectors' cash books and cash balances must be checked periodically, and the cash books must be promptly reconciled with revenue registers or other records used for control of collections. Accounting officers must also notify the Accountant General and the Auditor General of the establishment of any new revenue collecting office or unit. This is a very important principle. No control system removes the accounting officer's responsibility. The accounting officer must ensure all revenue is accounted for, all systems are working, and reconciliation is carried out between the cash book and the revenue registers. Money received by an officer not in possession of official receipt. If an officer who is neither a revenue collector nor a sub-accounting officer receives any money other than his entitlements in the course of his official duties, he must lodge the money into the appropriate government account without delay and obtain treasury receipts. The lodgement must be supported by a paying-in form, which is Treasury Form 15. When accepting such lodgement, the sub-accounting officer must determine whether the officer is likely to come into possession of further monies in the course of his duties, and if so, the sub-accounting officer must arrange for the officer to be supplied with an official receipt booklet. The rule here is simple. No officer is allowed to hold government money outside the official system. Financial Regulation 227. Revenue collection through the bank. Subject to the relevant regulations, unless the accounting officer or sub-accounting officer expressly authorizes otherwise, at all stations where there is a bank in which the government revenue account is kept, collections must be paid into the credit of the government account at the bank. The relevant bank credit slip, supported by completed Treasury Forms 15 or 15A in duplicate, must then be tendered to the sub-accounting officer in lieu of cash at the earliest possible time. So, where a bank exists, payment should go directly into the government account. The supporting documents are the bank credit slip and Treasury Form 15 or 15A. The exam trap is that cash handling should be minimized. Financial Regulation 228. Revenue collection by sub-accounting officer. Sub-accounting officers who function as revenue collectors must bring their collections to account directly into their cash books with the receipt acknowledged on General Receipt Form, Treasury Book 6, or the appropriate receipt or license form. This does not prevent division of work in a particular office. Any officer other than the sub-accounting officer may be supplied with a revenue collector's receipt book, Treasury Book 6A, and may be responsible for collecting specified revenue. But once that happens, such an officer becomes subject to all the regulations relating to the conduct of revenue collectors. That is the point. Financial Regulation 229, Cash surplus or shortage. Any unexplained cash surplus, shortage, or unknown bank receipts in any MDA or arm of government must be promptly brought to account. An unexplained cash surplus must be treated as a receipt, paid into the appropriate government account, placed in a suspense account, and reported to the accounting officer with a copy to the accountant general. The accounting officer must investigate the cause of the cash surplus, shortage, or unknown bank receipts and submit a report to the accountant general, who will advise on the appropriate treatment of the surplus or deficit. This is a very common exam area, so remember the rules clearly. For surplus, treat it as revenue, pay it into account, place it in suspense account, and report it. For shortage, investigate, and report immediately. The accounting officer investigates. The accountant general advises on the treatment. And here is the exam trap. A surplus is not personal gain. It must be reported. Financial Regulation 230, Interest on bank deposits. Interest earned on bank accounts must be properly classified to the appropriate revenue line items and paid into the appropriate revenue account. That is the rule. If you are serious about passing this exam, don't stop here. I've prepared the complete study materials for you. Detailed ebooks for Chapter 1 and Chapter 2, clear audio versions you can listen to anytime, and if you want the best value, get the full bundle, ebook plus audio combined. Everything is already waiting for you. Check the link in the description and the pinned comments now. Financial Regulation 231, Deductions from Revenue Prohibited. No deduction shall be made from any revenue collection or other receipts to adjust a previous overcredit. The gross amount received must, on all occasions, be accounted for in full. The procedure for refund or set-off is prescribed elsewhere. This is the gross rule again. No deduction is allowed from revenue collections. Record the full amounts first. Adjust separately. That point must be remembered exactly like that. Financial Regulation 232, Revenue due to the federal government. The following general principles apply. All accounts or statements requesting payment of revenue due to government must be sent out in advance, and they should show the date by which payment should be made. All services rendered by government must be paid for in advance or immediately on completion of the service. Where payment is outstanding, a system of follow-up by means of reminders and final demand through available communication channels must be used. A demand note must be used for this purpose. Accounting officers in all MDAs and other arms of government must lay down definite instructions for the reporting of revenue receivable at an early date to a designated officer for decision as to the action necessary to enforce payment. And that action may include legal action. So, the key principles are: send demand in advance, require payment before service or immediately after, use reminders, use final demand, use legal action where necessary, and the key enforcement tool is the demand note. Financial Regulation 233, Revenue Receivable. Revenue receivable means revenue collectible during a given financial year, but which remains uncollected by the end of the financial year. The Accountant General reviews the list and, if satisfied, seeks the approval of the Minister of Finance for the write-off. The Minister of Finance must from time to time furnish the Auditor General with a list of cases in which it has been decided to write off or remit such arrears, with the reasons entered against each case. So the process is: Accounting Officer prepares the list, Accountant General reviews, Minister of Finance approves. And the exam trap is this: only the minister can approve the write-off. Financial Regulation 240, Loss of revenue by negligence. If at any time a public officer causes a loss of revenue due to negligence, that officer is liable to be surcharged for the full amount involved. That means negligence creates personal liability. That is the exam point. Financial Regulation 241, Remittance of WHT, VAT, PAYE, and stamp duties. It is mandatory for accounting officers to ensure full compliance with the remittance of pay as you earn, stamp duties, value-added tax, and withholding tax due on supplies and service contracts. Any loss of government revenue caused by non-deduction or non-remittance of VAT, WHT, or stamp duties to a contractor, or failure to deduct and remit PAYE to the relevant tax authorities by any MDA or other arm of government shall be recovered from the statutory allocation due to the defaulting MDA or arm of government. Any accounting officer or sub-accounting officer who fails to deduct or remit PAYE, stamp duties, VAT, and WHT due on vatable supplies and services shall be sanctioned under the applicable acts. That is the consequence. Financial Regulation 242, Remittance of taxes deductions or remittance of PAYE, stamp duties, WHT, and VAT must be made to the relevant tax authorities at the same time the payee, who is the subject of the deduction, is paid. So the rule is simple: deduct, remit immediately. Failure leads to recovery from allocation and sanctions against responsible officers. Again, in your updated exam interpretation context, stamp duties have been abolished as at the 31st of December 2025. Final high-impact exam takeaways. Now, let us close with the most important takeaways from this chapter. Memorize them clearly. Revenue means gross inflow. CRF is the federal government's main account. Federation account is the shared revenue pool. Exchange versus non-exchange means value versus no direct value. Fully funded agencies remit 100%. The 14th of the month is a major deadline. The 14th of January is the deadline for returns. No temporary receipts are allowed. The Cashbook must be daily, serial, and verified. There must be no withdrawal from the revenue account. Surplus must go to suspense account and be reported. Shortages must be investigated. A null return is still required. Write-off requires ministerial approval. Negligence leads to surcharge. Demand note is the tool for enforcement. A sudden increase in arrears may indicate fraud. And deductions must not be made before bringing the full amount to account. The Accountant General reviews the list and, if satisfied, seeks the approval of the Minister of Finance for the write-off. The Minister of Finance must, from time to time, furnish the Auditor General with the list of cases in which it has been decided to write off or remit such arrears, with the reasons entered against each case. So the process is: Accounting Officer prepares the list. Accountant General reviews. Minister of Finance approves. And the exam trap is this: only the minister can approve the write-off. Financial Regulation 240, Loss of revenue by negligence. If at any time a public officer causes a loss of revenue due to negligence, that officer is liable to be surcharged for the full amount involved. That means negligence creates personal liability. That is the exam point. Financial Regulation 241, Remittance of WHT, VAT, PAYE, and stamp duties. It is mandatory for accounting officers to ensure full compliance with the remittance of pay as you earn, stamp duties, value-added tax, and withholding tax due on supplies and service contracts. Any loss of government revenue caused by non-deduction or non-remittance of VAT, WHT, or stamp duties to a contractor, or failure to deduct and remit PAYE to the relevant tax authorities by any MDA or other arm of government shall be recovered from the statutory allocation due to the defaulting MDA or arm of government. Any accounting officer or sub-accounting officer who fails to deduct or remit PAYE, stamp duties, VAT, and WHT due on vatable supplies and services shall be sanctioned under the applicable acts. That is the consequence. Financial Regulation 242. Remittance of taxes deductions or remittance of PAYE, stamp duties, WHT, and VAT must be made to the relevant tax authorities at the same time the payee, who is the subject of the deduction, is paid. So the rule is simple: deduct, remit immediately. Failure leads to recovery from allocation and sanctions against responsible officers. Again, in your updated exam interpretation context, stamp duties have been abolished as at the 31st of December 2025. Final high-impact exam takeaways. Now, let us close with the most important takeaways from this chapter. Memorize them clearly. If you are serious about passing this exam, don't stop here. I've prepared the complete study materials for you. Detailed ebooks for Chapter 1 and Chapter 2, clear audio versions you can listen to anytime, and if you want the best value, get the full bundle, ebook plus audio combined. Everything is already waiting for you. Check the link in the description and the pinned comments now. Revenue means gross inflow. CRF is the federal government's main account. Federation account is the shared revenue pool. Exchange versus non-exchange means value versus no direct value. Fully funded agencies remit 100%. The 14th of the month is a major deadline. The 14th of January is the deadline for returns. No temporary receipts are allowed. The Cashbook must be daily, serial, and verified. There must be no withdrawal from the revenue account. Surplus must go to suspense account and be reported. Shortages must be investigated. A NIL return is still required. Write-off requires ministerial approval. Negligence leads to surcharge. Demand note is the tool for enforcement. A sudden increase in arrears may indicate fraud. And deductions must not be made before bringing the full amount to account.